So thank you everyone for joining our PropTech webinar this morning. I'd like to thank our panelists who have joined us: Joe Hanna from PropTech Group, Peter Gibbons from Openn Negotiation, Michael Davey from RMA Global, Keith Falconer from Future First Technologies, which owns farmbuy.com, and Greg Bader from rent.com.au. So we're going to start with a presentation by each of our panelists, just a brief 10-minute just to run through the businesses, and then we'll go to Q&A. So Joe, I'm going to ask you to start and share your screen and go from there.
Excellent. Thank you, Finola, and thank you all for joining. So my name is Joe Hanna. I'm the Group CEO and MD of PropTech Group. So let me spend the next 10 minutes running you through a little bit about what we do and how we've progressed since IPO in November of 2020. In a nutshell, PropTech Group is a simple and rapidly growing business. What we essentially do is provide software to real estate agencies that they depend on all day, every day. So this is the mission critical software that an agency needs to operate their back office. We're growing fast. Our cash receipts climbed almost 100% in Q1 of this year when compared to last year. And we've added a number of additional features, products and services that will continue to accelerate our revenue growth because our customers are asking for them and they are more than happy to pay for them. We're primarily a SaaS business. Over 85% of our revenues come from SaaS. So that's fairly protected revenue. It's unlikely to decrease in a downturn, and we can talk about that a little bit later because they pay us a monthly subscription fee. Typically, our contracts are long-term, 12-month plus, with our longest contract being, I think, over 3 years. We're now looking at new revenue opportunities through transactional revenue streams. And these are very large addressable markets. And I'll talk to these in just a moment. But we have a number of initiatives. One that we've most recently announced is the payment solution called RelloPay, which helps real estate agencies and vendors with their vendor paid advertising and agency commissions. The interesting thing about our business is we've built a defensible moat. And this is largely due to the high cost of switching from your core back office systems. We have both a size and cost advantage to our competitors who are smaller and more expensive. Our customers like our product so much that we have an average tenure of over 8 years, and many of our large customers are also large shareholders of the business. A little bit about our product suite and our market dominance, particularly in the sales CRM part. When we IPO'd the business in November of 2020, we IPO'd or relisted rather with about a 26% market share. Now that's by number of agency offices in Australia and New Zealand using at least one PropTech Group product, primarily our sales CRM. We're now at 41% market share, which is significantly larger than the next 3 competitors combined. And that's really across a range of products. At our core, our CRM products includes Eagle, which is a recent acquisition finalised in July of this year. Vault RE is our enterprise-grade property management and sales CRM solution for both residential and commercial, all in one. And it's really targeted towards that top end of town, large multi-office franchise groups, including Ray White, Rain & Horn, Harcourts, to name a few. My Desktop was an acquisition from Domain that will be decommissioned soon. And H1 was the acquisition of a customer base from Harcourts, which will also be decommissioned. So ultimately, we'll end up with 2 core CRM products, Vault and Eagle. But we also extend those products, not only on products that we own ourselves, but also third-party products, including both RMA and Openn Negotiation, who you'll hear from today, through deep integration within our CRMs. And the idea behind that is that we want to provide our agents with a single platform to enable them to operate their entire business. So some of the extensions that we own ourselves are Rent Find Inspect, which is a product for property management. Website Blue, as the name suggests, one of the largest, well, now the largest website developer or website hosting system for real estate agencies. And Designly is quickly becoming our market automation tool for marketing for real estate agencies. Our first entry into the ancillary product stream is RelloPay, cash flow and vendor paid advertising, buy now, pay later payment solution for real estate, which we're very excited about and has been launched officially later this month. And of course, we still have our B2C business, the original incarnation of PTG in Real Estate Investor, which is also growing fast and helping real estate investors find investment grade properties. As I mentioned at the very beginning, we have built an economic moat, a defensible economic moat with 8.5 years as our average tenure. This is largely due to the high switching costs of actually changing your back office systems. We have both the size and cost advantage to our competitors. We have large customers who are also large shareholders, including Ray White, Raymond Horn and Harcourts, with the first two owning more than 6% of the company. And despite price increases earlier this year, whilst having a superior product, we're able to maintain a cost advantage over our competitors, which does give us some future price elasticity. Our large market share enables us to dedicate greater resources on both R&D and customer service. And really, we are a tech business, so innovation is at our core, R&D is our core. So we continue to release innovative products, really aimed at streamlining, optimizing and automating the process of buying, selling real estate for real estate agencies to make them more efficient and therefore more profitable. And in doing so, making the experience of buying and selling more pleasurable for the consumer. What's really interesting to note, though, is we have a very large addressable market. And this is something that we're really focusing on. So one of our key objectives is to really capture a bigger stake of the addressable market, the short-term addressable market. So many of you may be interested to learn that in Australia, there are over 625 PropTechs operating in Australia alone. Real estate agencies spend roughly about $730 million a year on agencies' SaaS, PropTechs and related services. Now, that's a big chunk of their P&L that gets expended on SaaS tools to enable them to run their business. When you compare that to the large $1.5 billion vendor-paid advertising spent annually in Australia, and this is really what realestate.com, Domain, Google, Facebook all are fighting for a slice of the pie, it's a significant chunk of revenues. Above and beyond that is the massive ancillary services, referral and commission fees, which we estimate to be around $10 billion a year. Now, these are things like home loans, insurances, finance, conveyancing, utilities connections. So really at our core, our first driver of growth will be to capture a larger than our current 2.5% wallet of the $730 million spent by agencies per annum. And we do that by increasing the number of products and services that we offer to our existing customer base. So remembering that we have a 41% market share, but a very small slice of that money that's being spent per annum. As exciting, or for me, even more exciting, is capturing the greatest share of that additional ancillary revenue streams. And we believe we're well positioned to do that because it's all around the context of which consumers are being open to being served those offers. So those micro moments are where it really matters. We do this by leveraging off the relationship that an agent has built with their customers, be it the vendor, the purchaser, the landlord, or the tenant. And really leveraging through those core workflow automations of our SaaS businesses, the ability to then offer ancillary services such as home loans, finances, insurances, and the like. And again, RelloPay is our first foray into this space, many more to come, so watch this space, but it's a significant opportunity, of which us and many others are also trying to capture. As many of you may or may not know, that we are a growth through both acquisitive and organic, with essentially roughly 50% of our growth has come from both acquisitive and organic. And we know that we can grow companies faster under the PropTech Group umbrella. Probably the best example of that is Website Blue, a business we acquired in February of 2021, which up until September has grown by over 200% in terms of their revenues. So joining the PropTech Group family is really not a full acquisition and a shutdown. It's really around accelerating that growth through that single system to enable agents to do everything from the one place. So we look at companies that can help us in a number of areas, either offer new products and services to our customers, increase our ARPA, but also have the ability to leverage off our distribution capabilities to enable them to grow rapidly. So that pie chart that you see on the right, when we IPO'd that business, we only had those first two segments in blue, CRM, property management. We've now got solutions in agency marketing, solutions in finance and ancillary services, and we'll continue to tick off as many as we can of those yellow shaded areas. In terms of our board, we've managed to assemble a very exceptional board of experts, with Simon Baker, as many of you will know from XREA, fame as our chairman. Since then, he's done a lot more, went along to be a chairman of companies like iProperty, Finola Group, and is now currently involved with a couple of NASDAQ listings through the US. Quick background into me, I've been in PropTech for over 25 years now, with multiple founder, multiple investor, multiple NED and IPOs, 6 years of experience on the ASX, including Finola Group, as well as obviously real estate investor and now PropTech Group. Scott Wolf was the founder of both My Desktop and Vault, so his extensive experience, particularly in the CRM space. Sam Plowman, many of you may not know, but was the GM of Domain at the time that they purchased My Desktop, and has since then been heavily involved in fintech. And York Schmiel, many of you will know from many roles, potentially LJ Hooker, iProperty, REA, and most recently executive chair of Duai IQI and chairman of iCar Asia. So short, sharp and sweet overview of PropTech Group. But with that, Finola, I'll finish up by really just giving people a quick overview to our performance of our first quarter. And this was released a couple of weeks ago in our 4C. We've had a good quarter that's continuing into the second quarter, $5 million in cash receipts from customers, which is up 99% against prior corresponding period, $600,000 in net cash flows from operating activities, $14.8 million in the bank. A couple of things that we finished in the first quarter of the year was to complete a $15.5 million capital raise, completed the acquisition of Eagle Software, which further bolstered our penetration into the CRM space, particularly in the small independent, small boutique, multi-office groups, and completed and announced the JV for the integrated payments and cash flow solution called RelloPay. So with that, Finola, I'll end and defer to the next.
Thank you, Joe. So Pete, if you'd like to share your screen and start your presentation, that would be great.
You're on mute, Pete. You're on mute, Pete.
Okay, and I'm back. Can we see that on our screens? Very good. Thanks for that, Joe. Great presentation, Joe. Right, let me tell you a little bit about Openn. It might be worth getting an understanding of what Openn is, because it's a relatively new concept and process. So we started about 6 years ago. My founding partners are real estate agents, and we wanted to come up with an enabling tool to assist agents in their transactional process. So I asked them, look, really, what is your biggest problem? And they said it's transparency. And so digging deeper on what is their problem with transparency, really, it was all about when they put a property to the market, somebody liked the property, and they say, I like the property, how much do I need to pay? The agent immediately comes back with, look, can't tell you, but I do have 3 offers over here. And immediately there's that lack of transparency, there's that lack of trust, but more importantly, it generally ended up in 1 or 2 areas. It was either, congratulations, you've purchased the property, and the buyer's thinking, have I overpaid? I did not know where to pitch myself. Or probably worse, when the agent goes back and says, sorry, you missed out, it went for $800,000. And they say, look, I would have paid that, or I would have paid more, but you didn't tell me what I needed to pay. So in that instance, the buyer's leaving unhappy, the seller's left money on table, and the agent's the poor one in the middle who hasn't been able to seamlessly transact that. So in a nutshell, that's what we were trying to solve. And we solved it by creating a platform that allowed you to seamlessly transact with showing the prices. So that was quite a process to get to there. We're now throughout Australia, New Zealand, into the US, but the legal aspects behind that are really important, and that's taken an enormous amount of time to get right. and then of course building out the technology. So we created online auction, which falls under auction law. I meant the legal part. That's worked exceptionally well. I'll show you some numbers in a moment. But what we had agents saying is, look, we love this, but we also do private treaty, we do tender, etc. We said, well, no problems. You tell us what you want, we'll build it. So we released open offers a couple of months ago. That's been phenomenally successful. The take-up is quite impressive. In our next release, we've got open tender coming out, which that's been driven by demand from rural sectors and, funnily enough, commercial sectors as well, who tend to use the traditional tender type method. And open access is really simply just a button that the agents can pop on their websites to transact their own contracts. So in terms of growth, we listed in July. In July, we were seeking to be 5% of the national market by June 2024. To get there, we needed to grow at about 5% compound monthly growth. We're growing at almost 13%. So we're shooting our targets out of shooting the lights out in terms of our actual targets. But more importantly, it's getting that message out there that there's a way to transact that agents can use as their enabling tool to run their life more simply, to take, we've got agents saying we're running 30, 40, 50 offers at the same time, and we're doing it seamlessly. Now, they never would have been able to do that right up physically. They tend to write up 3, 4, 5 offers. This maximizes the market that can participate, which obviously maximizes or optimizes pricing. So another just example of where we've grown. So come from January to now. I won't go through all the numbers, obviously, but you can see there, if you make the comparison, it took us 4 years to get to 20,000 qualified buyers. We're now 46,000 qualified buyers 11 months later. The total amount of property actually transacted through the platform, almost double. These sorts of stats are telling us that we're going in the right direction. In terms of, we've got a number of partnerships. For example, Joe mentioned earlier, we're deeply integrated with Vault, the CRM. So we want to make it so the agent can use whatever they use currently, and then be able to access Openn as well. We've got strategic partnerships, which are more national partnerships with agency groups. The partners in the middle there, they're about, if you think about it logically, we're capturing buyers and sellers at the time that they really need a whole bunch of different things, like property settlements, for example. So we're assisting them there with potential groups that they can use. And the third one there, and I think we're going to touch on it later, but the REACH program is the National Association of Realtors, the institute in the US. We understand we're the first group that's been asked into 2 REACH accelerator programs in the world, and we'll touch on how important that is to the growth of the business. The North American expansion, this is incredibly exciting for us. We transact probably 450,000 properties in Australia. You can see the numbers, about roughly 6.5 million in the US, and even Canada's larger than us. Canada is fascinating because we were invited by REACH into Canada. As I say, we're the only group to be invited into 2 programs. We understand that is because the Trudeau government came out as part of their platform to be elected with that they were going to end the trauma in real estate of blind bidding. So we were approached, that's the exact problem we were trying to solve. So it's an exciting opportunity for us. And obviously the size of the US, we've got Century 21 and REMAX in a pilot program running in the northeast of the US at the moment. And the overwhelming response from everybody is, thank God we need transparency. So right place, right time, hopefully. There's obviously other initiatives that we're working on, additional products coming on, collaborative arrangements with various groups. I think probably the big one and the exciting one for us as we get to statistical significance and scale is around the data we capture. This is automatically generated when a property sells using Openn. So you're not just seeing the sales price, but you're actually seeing the depth of market support by fully legally binding contracts sitting behind offers, which really, if you think from a valuation perspective, it's really, really important. from banks knowing where the market actually is. Interestingly, we sort of, typically the data that is currently available in real estate is backward looking. It's around what's sold in the past and how much, whereas we've got in real time, not only what things are selling for, but the depth of market support for them. So there's a real opportunity here to start creating lead indicators in the market. If you can see the qualified bidders dropping off, if you can see the number of bids dropping off, the days of market increasing, these sorts of things are going to be telling you where the market's actually going rather than looking backwards and say where the market's been. So a number of groups obviously interested in partnering with us in relation to this data, and we've clearly identified partnering is the way to go to grow our business. So we're certainly looking to add those partnerships very closely. Finally, hopefully some of you are trying to sell houses. So this is probably a good example of the depth of market data that comes out of an open negotiation. But this is just really, since we listed, we're starting to get a feel for how hot the market is. Now, the reserve price is generally the dream price, what people would love to sell their property for. Basically, 1 in 4 properties that we're selling through the platform at the moment are selling for more than $50,000, more than the dream price of the buyer. So that's very, very interesting. It's certainly, if you're selling a property, it's a great platform to be selling your property through, so contact your agent. But probably more importantly, or as importantly, the buyers are saying, well, this is great because every other time I was willing to pay more, but I actually missed out. Now I know exactly what to pay. I'm actually happy to pay that $50,000 more to secure that property in what is a hot market. And again, I think we'll talk about what happens when markets move, and that's even more exciting. So hopefully that gives you a feel for what is open negotiation. Thanks, Finola.
Thanks, Pete. That was great. If you'd like to unshare your screen, and if Keith, if you'd like to pop up and share your screen and give your presentation, that'd be great. Just unshare it, yep.
Can everybody see that okay? I've downloaded a PDF, not a PowerPoint. So, okay. Yeah, Phoneby. Yep. Phoneby has been going since 2009. Various different ownerships. Me and my business partner acquired it in 2018. Reason why we acquired it, really strong brand name, really good SEO, and had a real strong base to go to that next level. We redeveloped it, got it to a point where we needed investment, and we sold it to FFT in April of 2020. So in its new format, it's been going about 18 months, coming up to 2 years in April. Our position today is, the numbers are, we try to focus on obviously building the audience first of all. Our strategy has always been to build an audience first and then look to expand and I guess adjacent opportunities. Where we are currently, moving into the summer period, got 160,000 users, 480 real estate agents, 30,000 subscribers. We're generating 2,500 leads a month, which is obviously really important. We're truly a classified model at this point. So you've got to deliver response, not just eyeballs, and 310,000 sessions a month. So we platformed last August, just at the start of the COVID lockdown. So, we really wanted to focus on building their building blocks for the next level so we can execute the strategy moving forward. The strategy is we really want to build Australia's premium agricultural player. We've always known that real estate on its own can provide a really strong market, but the opportunity to expand into, I guess, an agri play is what our focus has been from day one. So first priority was obviously develop audience with the rural market, but also strong relationships with the agents. The key agents for us are the agents who not only sell real estate, but they also sell livestock and also do the clearing sales. So our focus has really been on them guys, true rural agents, And that's what we've sort of been developing relationships over a period of time. We've got 480 agents. We've got 35% now of the rural listing market. We're generating 25,000 leads. So that relationship's really strong. We've built a really good sales capability in the last year, basically only since February. Post-lockdown, we put the sales team in place, started monetizing the platform really strongly. Listings are growing, ad revenue is growing. And the next bit of that building block is the scalability, the technology, auction platform technology, and a strong management team to go to that next stage. The plan. So the plan has always been to use real estate as a bridgehead into their relationships, grow audience, grow agent relationships, grow brand and trust. We're in a pretty good relationship situation because there's some pretty big behemoths out there, and most of them are looking for that alternative option to provide some balance in their financial commitments. So next stage for us is we're partnering with a company called Farmgate, Australian tech company, to launch livestock auctions in the new year. So off the back of that, again, growing audience, growing the data. By doing livestock auctions, it provides us to get more login and more transactional opportunities with the customer base, extend that agent relationship even further, and grow customer interactions. Real estate, obviously, you might buy a farm every 5-6 years. What we're trying to do is develop that interaction, that constant interaction of transaction and livestock's a massive opportunity for us. The next rollout will be clearing sales. Again, we want to differentiate ourselves from that pitch. When your real estate agent sits down, your farm rural agent sits down and say, hey, you can sell your farm on Farm Bar. We can also do dispersal sale on your livestock, and we can also maybe clearing sales. So expanding, we think that'll get us to about 60% of the overall, primary farming community. Again, further growing audience, leveraging the agent relationship, and growing customer interactions. More customer interactions, the more opportunity to transact. We think there's a great opportunity then to put supplies and retail in there. Again, we'll look to partner with someone who's currently got the platform, grow audience database, widen the customer base, and retail supplies. And I guess at the end bit of that is, if we've got people doing transactions with livestock, we've got people doing multiple transaction clearance sales, building that brand and trust. The next stage will be to partner or launch our own financial services in the future. That's a very high level strategy. Where we currently are today, our revenue run rate will be 750 by the end of December, annualized. Start of the year, that was post-COVID, we're around about 200 grand. So it's fastly growing. So we're moving into new year with the auction platform in place. Lots of positive discussions around participation with agents, and that's what we do. Thank you.
Oh, thank you, Keith. That was a great presentation. If you could stop sharing, and if Michael could put up his presentation and start that, that'd be great.
Okay, you hear me okay?
Yep.
Great, okay, thank you. All right, so I'm Michael Davey, I'm the CEO of RMA Agent. So this morning I just wanted to give you a quick overview of our business and what we do within Australia, New Zealand and the US. So we're a platform that really helps agents stand out online. So we collect comprehensive data on sales results and reviews of agents' performance. So we're a review, a marketing and a customer satisfaction platform for real estate agents and agencies. What we enable them to do is to develop social proof. So we allow them to collect reviews, market themselves on our platform and through social media. Consumers can then use that data and information that we make available online to find out who are the best agents, who's getting the best results, and who can I trust, who is the most transparent out there. So currently we really dominate in Australia. We've got over 75% of active agents on the platform, and we're growing rapidly in the US and New Zealand. And when we look at Australia, we believe there's around 35,000 active agents who've transacted the property as a lead agent. There's only 11,500 of those that do 80% of the transactions. When we look at the US, for context, we think there's about 900,000 active agents who've sold or have been involved in a transaction. There's 290,000 who really do 80% of the transactions in the US. So those top agents are the ones that we're really focused on serving. And what we enable them to do is to really create that supercharged LinkedIn CV for agents online, which ranks in Google and becomes that signal of trust with prospective customers. So I'll talk about the US to kick off to give on a flavor of that. But really what we've been focused on is a couple of stages in our business. The first stage for us is really creating that database of agents and all their listings. So we've nearly got 1 million agents in the US where we have all their for sale and sold listing data. And we do that by connecting to all the major listing services. So we've really been building that database over the last 4 years and have hit a key tipping point to get over that million mark. Once we do that, we invite agents to come onto the platform and claim their profile. So we've now got 160,000 agents in the US. That's growing rapidly at the moment in terms of starting to engage with the platform, building out that online CV with our profile, and then more importantly, starting to collect reviews against that. And I'll talk about our review growth over the last 6 months, which has really started to pick up in certain key markets. So when they click that review, it's that piece of social proof that can be shared through social media. We create dynamic ads, which we can serve as well. And then we can all link that back through to their profile within what we're doing. So then importantly to those size of those markets, in Australia, we've really grown the business as well in the last couple of years coming out of COVID. And we've really been focused on usage in the US, where we get agents engaged to really prove out who's the best agent. And then we're starting to see that turn into monetization in the US as well. So again, we have quite some key ratios in our business where if we can apply that to what we're doing with our US business, then hopefully we can build that out. So building that funnel out has been really important for us, and not only engaging with major listing services in the US, but also now starting to do deals where we can co-partner with major brokerages. So we're doing that with RE/MAX, which is about 85,000 agents. Berkshire Hathaway is about 65,000 agents, and Realty One and Exit about 25,000 each. So we're getting closer to the transaction as possible in the States, and that enables us to build a relationship with the agent, collect reviews, and to help them build that profile out. For us, we are a review business. So, just to illustrate that further, our review growth strategy has been focused on a couple of key elements. Number one is really integrating deeply into the tech ecosystem in the United States. So we're really focused on generating automatic reviews. So on this chart below, you can see in March 2019, this is an example of North Miami, Fort Lauderdale, Broward County, we had 115 reviews. So we're really, the US is a collection of markets. Florida is the size of Australia alone. It's 24 million people, about 600,000 transactions a year, 150,000 agents, but only 50,000 of those agents really matter who do that 80%. So we're really focusing as that next step on key geographies. And we've just launched our awards in the States as well, which has really driven huge uptake in terms of customer satisfaction. So then you can see these time slices here, how we've really built out every single dot is a review against the sale in that area. We're up to nearly 9,000 reviews just in that county alone in Florida. So really focused on a couple of the key markets within what we're doing. And we know that next step then is to monetize the agents through subscriptions. When we then break that down, we can really see a major step change since June, July this year. We've brought online, we've got a cleaner database, we've got new marketing systems, and on our awards within that, we're really seeing uptake in the platform, not only in review collection, but them using certain key tools in our platform. And that really helps them transmit and share their great results and the customer service they've done within that. And then again, a big part of this is us integrating heavily with them for Google. So again, not only collecting one review on our platform, we actually aggregate all the reviews in the US as well. But we also want to syndicate reviews and content where we can to become that sort of one-stop marketing shop for them in terms of the review and marketing platform. Within what we've been doing, that sort of summarizes where we've been in the, sorry, we'll skip a slide there. So then that pipeline is then translated into monetization. So we're now starting to see the ARR start to take off in the States. So our core product is a subscription, and you have premium tools you can use. But we also have a product called Promoter, where you can turn content into digital ads that we serve for an extra fee. So that's really starting to grow for us. And again, our goal is to push this through and become cash flow positive as a business with the US driving that. So that's the US. Australia's home, always will be. We've got some great results coming through in terms of what our model here. So again, through working closely with more major groups here in Australia and really focusing on those top agents, we're starting to see subscription revenue continue to tick up on the left-hand chart. So we're up 29% quarter to quarter for Q1. And then again, on the right-hand chart, our promoted product has really grown through COVID. It's taken a slight pause because we come off our seasonal sales with our award period, but that's well and truly picked up again in the last couple of months within it. So again, we're still continuing on focusing building the business in Australia, integrating with several major systems here and making it easy for agents to collect reviews and share them to as many places as possible to generate potential sellers down the track. New Zealand is a small market, but it sort of tells the tale of what we're doing in the US. Is on the left-hand chart, we get agents engaging with the platform and claiming the profiles, and the reviews start to take off. And that's a great thing, because then on the right-hand chart, you can start to see the monetization start to kick in. So building that subscription base and Promoter, again, a little bit of a flat spot following the awards, which is always February in Australia for us. But our ARR is up 188% year on year within that. So by delivering that profile and that value to agents, we've really seen a bit of a step change in terms of our revenues. So we've seen our highest levels of platform usage. November was our biggest review month ever in Australia, New Zealand, and the US with what we're doing. So we're seeing really strong agent engagement and top agents using the platform. Got a strong balance sheet in terms of where we're at, and our team is really highly engaged. So we're Melbourne based and really been through the mill over the last year. So, we've been able to grow the business domestically and internationally whilst working all remotely. And we haven't been able to get back to the States for the last 2 years or year and a half within it. And, we continue to focus on the basics in our business and really continue to push towards monetizing agents here, but also in the US as well. So our goal is really to become cash flow positive by the end of the financial year on a monthly basis, and really continue to build that footprint in the US and within key markets. So hopefully that gives you a flavour of who we are and what we do. And yeah, I'll probably just conclude there for today. So
thank you, Michael. That was really comprehensive. Thank you. So Greg, if you wouldn't mind sharing your screen and starting your rundown, that'd be great.
Right, thank you. And yeah, cracking presentations from everybody. Greg Bader, CEO of Rent. I guess we're obviously in the rental side of the business. As you can see from the previous presentations, we as Australia have a bit of a fascination with property. Unfortunately, it tends to be focused more on the sales side. So in Australia, we have this perception that renting is somehow a negative choice or a secondary choice. And I guess that's our job, is to bust that. We have 30% of our population renting, and the largest group of renters are what we call our logical renters. And these are well-educated, well-traveled. These are people that are investing in crypto, in the stock market. They're choosing to rent right now because it suits their stage of life. They're not going to drop $1 million on a mortgage in Sydney and lose flexibility and lifestyle choice. So that's the group we tend to focus on. We have two parts to our business. Our portal business, Rent, we consistently grow. We're doing well. We're in top 4 portals in the country. More recently, we launched our Rent Pay business. And the key difference between the two is one's the search phase, average about 6 weeks every 30 months. The tenancy phase is where Rent Pay plays and allows us to maintain that permanent relationship with customers. So our portal business is doing really well. We're only 25 staff. We're based in WA. We're up against some giants. Really proud of the fact that we're the #1 real estate app on Google and Apple. We have 1.2 million renter resumes, which is our online application tool. We have over 100,000 people a month just coming to our site for tips and tricks and how to navigate the renting journey. So we're really proud of where we are, largest bond financer in the country, a lot of growth left in the engine, but for our size and for our scale and focusing on just a single segment, we're doing really well. We also, on our portal business, became profitable for the first time. 5 years ago, we were over $1 million a month in the red. So to turn that around whilst also investing in new product and new services has been a really proud moment for the group and something we look forward to continuing. So this is where we're at now in the RentPay space. We, as I mentioned earlier, the focus here is extending our relationship from the search phase into the tenancy phase. It's a massive opportunity. Only 5% of renters are looking for a property at any point in time, and 95% are happy in their tenancy. So this allows us to address the entire market. We're talking a $60 billion market in terms of the value of rent paid each year. So this is kind of the crux of what RentPay is. It offers flexibility to the renter, and it offers consistency and certainty back to the agent. I guess wrapping all this up is really around that flexibility piece. We have customers that want to pay weekly, but the agent prefers monthly. So there's all that time shifting. We also do value shifting as well. So we have over 40% of our customers are indicating that they want to overpay their rent. Now, that seems a little counterintuitive, but if you look at casualisation in the workforce, we've just been through nearly 2 years of COVID. So there are a large portion of our renters out there that have I guess, flexibility on their income side. So allowing them to build a buffer, save for a rainy day, etc., is really important. We have tools in there that provide emergency funding if your car blew up on Wednesday and your rent's due on Friday. But most importantly, we're building this model of around reward and recognition. Our mission, I guess, is everybody needs to pay their rent, but we want that rent to actually count for something and earn you something. So we're off and running. We launched a few months ago. It's starting to get some good traction. We're planning on a major marketing campaign for next year, but early signs are pretty good. We've paid over $4.5 million in rent. The challenge we've had is we've created an entirely new segment, not just a new product. So we're the first payment engine in the market where we expect or we hope customers will choose to use us. The score builder component we've added in there is really interesting. It's the first time it's been done in Australia. So each time you pay your rent and you regularly pay your rent, will positively contribute to your credit score. So it's never been done. So the theory behind this is that your financial standing or your position, if you like, over 1, 2, 3 years of renting will be better off for the fact that you've used RentPay. Now, whether that means you pop out into the mortgage land or for a car loan, your position will be better for the fact that you've used our services. This is probably the most exciting piece about RentPay. We're building up an ecosystem and a platform here. So all the functionality, trust accounting, payments in, payments out, we're bleeding edge in terms of the banking rails in Australia. We use instant payments out. We're partnering with ANZ Bank to be an early trial customer of scheduled NPP in. So the functionality and, if you like, the mechanics of the product will get better and better as Australia's banking rails catches up. But we're also talking to partners. Now, a couple of these were pretty close, but there's some real opportunities here. And the scale of it becomes mind-boggling. Just picking on the utility side there, if we've had a large portion of our customers want to pay their utility bills in line with their rent. So rather than the traditional pay for 3 or consume for 3 months, then get 30 days to pay, if we can synchronize people up with paying their utility with their rent, at 10% market share, we're looking at a $50 million cash flow advantage to a utility provider. And then there's a corresponding benefit in bad debt as well. So that's something that's incredibly logical. We're working in the home loan space as well. This is really important. We want to get to a point where your regular rental contributions build you up some benefit in terms of a future mortgage. The advantage to a mortgage partner is obviously that this accrued benefit means that when our customer does hit the mortgage market, they're less likely to shop around, of course. And there's a bunch of other ones in here. It's really exciting. As I said, a bunch of conversations going on at the moment. And this is, we expect some news on this through January. In terms of outlook, we've had a best ever last FY and we've started off well this year. We've been asked a number of times, as of others, about what's going to happen in Jan, Feb, March. It's going to be strong. We're normally seasonally strong in January, Feb, March, but obviously a lot of it's to do with the borders. But we expect it to be a pretty big year. We're well funded. We've got a bunch of new product and services coming through the pipeline. We're really, really pumped and looking forward to a cracker of a 22. Thank you.
Thanks, Greg. That was great. Okay, so Q&A. If anyone would like to ask a question, just please use the Q&A box. I've got a few that I'll start off with, and hopefully we'll open up more broadly. Firstly, I'd just like each of you to comment on how a rising interest rate environment is likely to affect your business. And perhaps we can go in order of the speakers again. So Joe, if you'd like to kick off on that, that'd be great.
Yeah, so it's a good question. I guess for our business, we're a B2B business, so we help agencies. Really, that shields us from any of the macroeconomic concerns. And what we find is that typically for us, our churn is quite low, first and foremost, but most of our churn, more than half our churn, is involuntary churn. So that's typically either an agency switching from one franchise group to another or closing up shop. So in our business specifically, what rising interest rates do is it means the agent has to work a little bit harder, which means that they rely on our tools even further. So for us, the core benefit of what we do is automation, workflows, some of the things that typically the agent would need to remember to do, we can automate on their behalf, and really kind of tapping into that data. So, and really this is an ecosystem. So if you think about what Pete mentioned around data, it's really the core systems that agencies use all day, every day. Combining that with the data that we're getting from multiple sources provides the ability for us to automate what message to send at what time, what buyer needs the extra prompt, what phone calls to make at an appropriate time, because we know agents are very focused on the transaction. The best agents are also very good at relationships. What we want to do is level out that playing field when it comes to relationships so that the agent focuses on those relationships. So automation, understanding that there are movements, being able to prompt the agent or automate rather an email that goes out or an SMS, or prompt the agent to make a phone call at an appropriate time, is probably the impact I think we see from our business.
All right. Pete?
Yeah, look, for us, it's almost quite exciting. You've got to remember Openn was developed in Perth, which was a very flat and declining market, which is usually what occurs when interest rates do rise. One of the exceptional feedbacks we got from agents as we developed it was they saw Openn as a really good tool to assist them with managing owner expectations. And what I mean by that is it's fine when the market's going up. If the market is declining, owners tend to have yesterday's value in their head, and that's what they want to achieve. Now, with Openn, with the bids and offers coming in, it's not the poor agent who's run around the entire market, come back and said, the best possible price I can get you is $1 million. The agent says, the seller says, you haven't tried hard enough there, keep trying. That puts the agent in a difficult position, but through the transparency of Openn, it's not the agent telling them what the property is worth, it's the market telling them what the property is worth. So agents with a declining or flat market really use Openn as a tool to assist them in guiding the expectation of the owner around what their property is actually worth. So I think should interest rates rise, now it's fascinating. I was looking, the World Bank is saying now, because Omicron, that's going to dampen things, but we've had COVID, we've had Delta, we've had Omicron. There's always going to be something. Assuming that interest rates do start to move upwards, Openn will just come to the fore as another benefit to agents to help them dealing with their vendors.
Great. Keith, how about Phoneby?
Look, I think the the key point is the slowing of the market. And I think what we've witnessed in the last year in particular is a very, very, very hot market. From I guess from a classified point of view, that's not particularly the best market. A large percentage of properties are getting sold before they go on market, therefore they don't get listed. So that's probably not the best dynamic. So if it slows a little bit, that's probably a benefit for us. You've got the lifestyle market, which I think will continue to be okay. You know, people looking to make tree changes, maybe selling out of the city, cashing in and making that choice. That will still continue. And if you look at the agri market is boom at the moment. Traditionally, during GFCs and downturns, agri land value, high quality farmer land has always been one of the best investments over that period of time. So we see that continuing to grow. And I guess a little bit of slowing of the market where the products that the properties are getting onto the market, whether being sold before, will be a real benefit for us. So I'm not wishing the interest rates to go up, but a slowing of the market would be definitely a beneficial environment for us to benefit from.
Michael, what?
Yeah, so I think, you know, in our short history, I think we've been through the Royal Commission where there was a real constraint on money. And then equally, we've been through COVID where key markets were completely shut. So I think, you know, we're a subscription business, and that recurring revenue is a great thing during those types of markets. I think, you know, when money's been extremely cheap, it obviously drives a huge amount of demand. And I think it's important to separate price versus volume and what's important for agents, because the volume of transactions is the key thing in terms of their business. So, you know, this looks like being one of the biggest years, I think, for quite some time. And, you know, I think the market will slow somewhat. It's been very, very hot, you know, but it doesn't remove the need for the agents to constantly find new business because they are a transactional business. So for us, they always need to have an always on profile. And that's really important to continue to have that presence, because when people do need to sell or think of sell for different various reasons, you know, the property market still keeps going. So the volume of transactions, I think, is really important to understand. Price may come off. I mean, we're seeing a little bit of that. The auction rates have dropped a little. You know, the steam's coming out a little bit. Buyers have herd mentality. You know, they like to operate, but it's actually the worst time to sell because you've got more competition. And, you know, people have more choice and there's less demand on price. So I think for us, it's really about just continuing to help agents, you know, promote themselves and prove they can get a great result in any market and really keep their vendors happy. Some really fascinating stats there from Peter as well on how happy they are with the price. We track that too. So, but for us, a subscription business, we've been through two major shocks here. It is slowing down a little in the US, but it's not material, like when you look at the volumes. So I think, you know, but an agent, the good agents, the top 20% will always need to prove their great results and continue to source new business.
And Greg, what impact would you see having on rent.com.au?
Look, if interest rates mean the sales side comes off a bit, but for us, it's about stock availability. We as a country have got some real issues that need to be addressed. If we look at the market today, we've got Queensland is absolutely diabolical in terms of stock availability. There's real issues with getting a property there. But then we look at Melbourne, where, you know, you rent one property, you get one free. They've got an overabundance, but nationally we're pretty tight on stock. We're well down on where we should be. I think the interest rates will have some effect, as I said, in stock availability, but for us in the renting world, the bigger impacts are opening the borders, immigration into Australia in an already stressed market, and probably one of the more interesting ones is the long-term impact of COVID and work from home, where we're seeing people not necessarily being tied to a suburban lifestyle. And the value of lifestyle is becoming more important. And do I need to live in that inner city apartment when I could be living out on the coast? So those sort of things, I think, are yet to play out fully in our market. And that's not just renters, that's home buyers as well. So it's going to be fascinating. But we've got elections coming up, and we'll all be sick of all the noise from that pretty soon. But I would like to see either major party properly address some of the rental shortfalls we have in the country.
Thanks, Greg. Just a question for Michael and Pete. You both have a bird's eye view of the US market, and at the moment there is pressure on interest rates. They are, for home buyers. What impact are you seeing on the market there at the moment?
I'm happy to go first. Look, I had a chat with the US team on the weekend. Interestingly, and I touched on it earlier, that now with Omicron, they're saying that things could be less pressure on interest rates. Again, as I say, there's always going to be something. So with the assumption, yes, there is pressure on them, they still see that there is the need, specifically in relation to Openn, for transparency. Because at the end of the day, when there are still multiple buyers interested, whether the price is going up or down, the way of getting optimum price is through transparency. Now, it seems to be that has been a very major issue. As I say, the Canadian government used it as part of their re-election platform. I think because it has never been available in the US for us, I'm not saying we're ambivalent to interest rate, but I think one of the panel made the point earlier that whether there's transactions going up or going down, that's what agents are interested in, transactions. So even as interest rates potentially rise, that could well lead to further transactions. I noticed, earlier in the year, there wasn't a lot of stock coming to the market. A rise in interest rates could well lead to a lot of stock coming to the market, which actually plays to our advantage, which, and I'm guessing Rate My Agent would be along those lines as well.
Yeah, I think I'd echo what Pete said. I mean, the prospect of the cheap money tap being turned off has certainly slightly dampened things in the US from what we can see in terms of volume of transactions. But again, price has been the major beneficiary of that cheap money in terms of the demand for the value of property. But the volume of transactions has softened slightly. But I don't think anyone would want to see the interest rates really get up there, because it's going to put a damper on the whole economy and turnover. So again, for us being a subscription business, they need to source those transactions and get deals done. So that's what we're seeing. But it's a very, very slight softening when you look at the volumes being done in the US as well. But there are certain key markets where great property will always sell despite the conditions. So there's certain areas where it will slow down a bit more than others because it is so big. But overall, it's a slight pause, I would feel, and depends on what happens in the next 6 to 12 months with those interest rates.
Thanks, Michael. Joe, PropTech Group CRM products have operated through both up and down cycles. Do you have any insights into the cyclical shifts that you can share with us?
Yeah, it's a good question. I guess the thing to note about a CRM is it's essentially the source of truth of data for agencies. So consider the workflow of someone that's looking to buy a house, going to realestate.com domain, clicking on the inquire button. Basically, from that point on, every communication from the agent beyond is through the CRMs. So what we've really seen in recent times, and particularly this is fascinating, I guess, for all of us, is with the new COVID normal, tendencies to virtual tours, virtual auctions. So certainly what we're seeing is the number of people that are engaging, the number of leads that are coming through to agents has certainly been on the rise, particularly during COVID, and again, driven by, fueled by low interest rates. Number of attendees to open for inspections, both virtual and face-to-face, has increased. And the number of contacts between a person, an agent and a person, has certainly increased. So what we find that in a down market, agents need to work a little bit harder, but that was before. And I guess the digitization of real estate, and as we, this group of panelists, are all contributing to that digitization, this data becomes so critical in allowing agents to make informed decisions. So we haven't really seen, we haven't had the data in a down market that's comparable to the data we have today. And by that, I mean, if with the next time we experience a down market, we'll know so much more about consumers. We'll know through Openn Negotiation, those that have made offers. We'll know through our systems what we deem to be active or passive buyers, those that are just getting a sense of the market, those that are actually in market. And there are explicit and implicit signals of interest. The explicit being actually attending an open for inspection, picking up a phone call, and the implied is just their search behaviours, their consumption of looking at a profile in RMA or Google via RMA and making an offer on Openn Negotiation. So increasingly what we're able to do is match a buyer and a seller for the agent using that data in a way that's a lot more targeted and a lot more kind of machine learning driven. So certainly historically, downturns have meant agents need to work harder. In an up market, agents need to they don't make the 100 phone calls that they need to. They can make 3 or 4 and properties will sell themselves. So increasingly the reliance on technology means that in a down market, they will need to work a little bit harder and technology will make it easier for them.
Thanks, Joe. Now, moving on to transactional services, which is the other part of what we wanted to explore today. Rent.com.au and PropTech are both moving into that transactional space with RentPay and Relo. What's driving the demand for transactional platforms? Greg, maybe you could kick off on that first.
For us, it's primarily about extending the relationship with our customer and adding value. So a couple of interesting side effects we're seeing at the moment. We, by building a payment product that a customer will choose to use first time in the market, we're actually creating a really strong secondary channel with real estate agents. So similar to Joe's point, we signed up over 7,000 rentals last week. We've got real estate agents that are looking to streamline their own businesses, save costs, save money. But one of the really interesting side effects of RentPay is that because we're focused on the consumer, we find an agency can utilize our product with zero pushback. So we're adding all this value to the consumer. It becomes a bit of a no-brainer for the real estate agency. Not only do they have a product that, if you like, we're taking care of all the complexity around time and funding management. We're providing them with all the reconciliation tools. We're also seeing, and I admit it, early days on our data, but it's looking really positive in terms of tenancy defaults, because we offer people safety net functionality, because we offer people buffering, because we link their payments to accruing their recognition and their status. Our customers are less likely to default on their rent. So that's a win-win all around for the agency as well. So we're the champion of renters. We're the only renter voice in the country. So yeah, getting into the transaction was a natural area for us because it's where we can add value and it's a massive market opportunity.
Thanks. And I think for us, and by the way, I love Greg's RentPay business. I think it's a great idea. Look, for us, it's been driven by agent demand, and for the similar reasons as Greg mentioned, but primarily on the sales side of the business. Agents are very transactional. And to ask an agent to remember to do something to make it easier for a vendor, for instance, is tough. So really, the reason we created RelloPay as a JV was there just wasn't a solution that was a perfect fit in the market. And there certainly are solutions out there. And to be fair, it's fair to say that agents have been doing buy now, pay later solutions for years with their credit cards, some agents funding vendor paid advertising themselves. Really what RelloPay seeks to do is take the need for an agent to have to remember to do something and give the choice back to the vendor in the instance of vendor paid advertising. And there are a couple of key drivers of that. Number one is with our data and our MENS data, we're able to make recommendations on the VPA spend for a given property based on real-time data, including things like Pete's data. For instance, what do you need to do to get your property ready for selling? Do you need to style it? Does it need a lick of paint? What type of package do you need on REA? Do you need the U-Butte, Platinum Plus, or can you get away with doing some more on social? And that recommendation being driven by data, where the vendor doesn't feel like the agent's just trying to push product down their throat, is important. Looking at sales history, looking at achievement above reserve, and then giving the choice to the consumer. I'll give you an example of my personal experience where I sold a house recently. I went through vendor VPA and I said to the agent, I don't want to go through a third party. I'll just pay you. And can I just pay with a credit card? And he said, well no. Gee, I don't know what to do. Got back to me 3 days later and said, here's our trust account, do an EFT. And that was a crappy experience as a vendor. So it's even just being able to pay by credit card, getting some Amex points when you're spending, in some instances, $10,000+ on VPA. So that's that part of it. Again, a streamlined experience for consumers. Full automation, full reconciliation to their trust account. So there's auditability, there's governance, there's transparency. So the agencies feel like they're covered as well. And then from the agent side, it's early release of commissions for vendors, or the early release of deposits. It's only really Victoria and New South Wales that have a deposit release capability. The other states don't. And again, so they're cash flow solutions that help agents and vendors get early access to their money. The net effect of that, the ultimate goal of that, is to make the experience, again, more pleasurable without the need for the agent to have a whole bunch of people back office actually running around doing things.
Thanks, Joe. And Keith, with Phoneby, you gave us a very good rundown of your plan and strategy to move from the livestock option, or from real estate to livestock options to other verticals. What sort of time frame are you talking about for that strategy?
Yeah, well, livestock auctions will start in the new year. And then we'll probably launch clearing sales middle of the year. They're the two key ones for next year. And that really is to build up that transactional base and have that opportunity when the agents pitch into the vendor to provide that total solution. We don't want to be in the discussion around REA and Phoneby, whatever. We want to have Phoneby totally separate. REA is a mass market site. It's got massive reach. Phoneby will sell your farm, it'll sell your clearance sale, and also you disperse as well. So that's where we want to sort of position ourselves. And the faster we can start building that transactional relationship, the quicker we can get to the transactional end of that journey. Farmers are traditionally, obviously, asset rich, but have these huge spikes in cash flow during the year. And despite the banks having as much historic data as you can get, there always is an issue around lending at certain times of the year. So to have a relationship with a customer who trusts you, that he might see somebody to clearance sale that he wants, and he's got a harvest in 2 months worth 2 million, or he's got cattle that are on a high that he's selling a bit later on. He just wants to sell them now. To provide that opportunity, bridging finance across multiple sort of different areas is a huge opportunity. And that's why we want to get these products in the market sooner rather than later and start building that relationship with the core customer.
Well, thanks, Keith. Well, it looks like 2022 is going to be a really big year for all of you. I'm looking forward to revisiting this at some stage. Thank you very much for your time today, Joe, Pete, Michael, Keith, and Greg. And we look forward to catching up again soon. Thank you for our attendees as well.
Thanks,
everybody.
Thanks for the opportunity.
Cheers,
Thank you.
Thank you.